Welcome, everybody, and let's start. A few words to Daniel.
Thanks, Larissa. So we just had the formal vote here. We also had a few votes sent in. All items were passed. Big surprise. In terms of our attendance, I like to point out that in the early days, Berkshire Hathaway, which some of you may know, after about 20 or 25 years since their start, and by the way, compounding returns at about 20 to 25% per year as well. They were about 10 attendees, and it's rumored that half were Buffett's family and the other half were employees or assistants of some kind. So looking at the attendance here, we're at least 20% ahead. So far, so good. I think for 2024, pretty happy with the year. We had a profit of around 17 million. It was largely driven by our US and UK holdings, but also to some extent Sweden and our China basket contributed a small bit as well. Sweden was tough, but yeah, I think we did relatively okay in our Swedish portfolio as well. Probably a big key, which is always the key to most good years, is to not have any real big misses. Mistakes will happen, and they happen every year, even in very good years. But I think the key in good years is that they are relatively small and they are relatively benign in nature, maybe temporary downturns in a company's business or something of the sort. Nothing permanent. I think has been the key for us in our good years. Yeah, I think that was the big thing on 24. It feels like 5 months in, it's already long forgotten by most people. So I think a key development is I'm pretty happy with the changes we introduced in March. I hope you've all seen that with our lower cost base. It'll be something that will benefit us for many, many years. Something I wanted to do for some time, and we have discussed on the board for some time, but now was a good time to go through with it all. So happy with that. On 2025, moving on to that, I think we've had one of the stronger starts to the year in a while. Our investments or our companies, more importantly, have done really well. The investment returns as well. But as you all know, the Swedish krona, we report in Swedish krona. So we had a very significant negative impact from the currencies. It's roughly, last time I checked, about 6% for us. So that's about 7 million or so. Of course, we have foreign shareholders as well, and they get this benefit added on top. But yeah, I think if you follow any Swedish companies that have international exposure, you have already seen that every single one of them is mentioning currency impacts this year, and I think it will continue if the currency remains where they are today. So yeah, it's important to remember this is a pretty extreme move. It's been our largest negative move since our first year, 2017. And it's been, we've had many positive years as well. And if you want to see how it has shaked out over the years, it's in the first, it's on the first page of all the letters under the table. So there you can see, I think all in all, it's a big benefit for us to not be limited to only Sweden. again, 2024 is a good example of that, where we were able to invest in other parts of the world, which fitted us a great deal. And I think it will continue to be a good benefit for us. Yeah, and I think on just investing in general, I think in April we all got a reminder that it's acting quickly and emotionally based on some happenings in the world is not the way to behave in investing. I think those who acted too quickly and emotionally back in early April regret it pretty much now. And it's simply not the right way to behave with this. It's human nature, and it's good to remember that we all have the human nature of wanting to. We get more optimistic when things go up, and we get more pessimistic when markets go down, and it's very good to be mindful of that and trying to do the opposite rather than anything. Yeah, I'll also mention our main goals. You all know them; they remain the same. It's we will think about the downside first. I think one of the key things in investing, which is tailwind business, you do have a tailwind over time in investing, so it's very important to be able to play the next day, every day. It should be high priority for any investment firm to be able to play tomorrow. And in my case here, I do have a lot of people, shareholders who I care a lot about. The trust they've given, they show in River Oak, and they trust me to be careful with their capital. So it's I want to be able to sleep well knowing about that trust, and I want all of you to be able to sleep well too. So that will remain front and center for us. The other goal is a 15% return over time, on average every year, per year, sorry. And this is a long-term goal. It was a long-term goal when we started in 2017, and I have seen no reasons to change it. We're not large enough that I think that's a problem. And even though we've been higher than that in the first 8 years, I do think it's very reasonable and a relatively high goal at that. So I don't think it's a timid goal at all, even though we have surpassed that by some amount so far. It's if we achieve it, we will be probably in the top 15 or 20%. And I'd consider that a pretty good result. Yeah, and yeah, I think it's very key here that this is a goal on average over time. So obviously we have seen that we can also have negative years. We can have years where we underperform benchmarks. I think we were all, during the first 6 or even 9 or 10 years, if you count the family office results, it's been, go a long period with no negative years and no underperforming years. It becomes a habit. It becomes a quite rough surprise when you have a first underperforming or negative years, but I think that should be much more considered the norm. I think if we can overperform about 3 in every 4 years or 2 in every 3 years or something, I would consider that a great result. And yeah, hope you do too, because anything else I find is quite unrealistic, even though we had that for 8 years. On our asset side, I think it would be healthy for our company to get to an asset base of around 200 to 300 million in a few years. It would open a few doors on the private side, which are not as open today. It would also open doors on being able to hire, analysts on a project basis or full time, and just overall, it's a more appropriate size for an operation like ours. So that's something definitely working towards right now. It will be a combination of returns and expanding the shareholder base, which will be done thoughtfully, and I don't know what the combination of that will be, will look like. We'll see, but certainly something that would help us. Finally, on that, it's also reduces our fixed cost base a bit, which we have mentioned in communications as well. Would be good for all of us. Finally, one question I get from shareholders on and off all the time, I think is, when is a good time to add to my investment, or is it better to do it now? Is it better to wait 1 or 2 or 3 years when the markets are down quite a bit, just like they were in 2022? And in my case, going back to what I said before, we did have a strong period up till 2020, 2021, at which point we had no sellers. During 2022, we did it. On 23, we didn't have too many buyers. We had some, but certainly less than in the previous years. And I think that's part of the human nature that I mentioned. I think that is something to be very mindful of if you want to get a good result. It's hard. It's hard for me when I invest on River Oak's behalf, but it is something that will really help return. So that's what I always say on that. Try to be aware of your human nature. Try to go against it. And you'll have a better result. So yeah, that was what I had. But I think before we go to the Q&A, we have a board member, Alex Pichler, who will not be with us over the next year. And he will focus more fully on his businesses in Italy. And as is our tradition, in part, since we have no board compensation at River Oak at this point, we do have a little nice thing for Alex here. I don't know to what extent you can see that, but he lives close to Rome in Italy, so he will have his chance to show off his golfing skills at the Ryder Cup venue in Marco Simone. So we'll see how that goes. I don't know, Alex, if you want to, I'll give the word.
Thank you for that nice gift. I had the good fortune to see the Ryder Cup and have seen great shots. So can you hear me?
I don't know if we hear you.
Yeah. No, I had the good fortune to see the Ryder Cup at this course, and I saw great shots. So mine will be less good. But thanks nevertheless. It was a great time to be with River Oak. I've enjoyed working with you, Daniel, and also with Amir. It was fantastic, and I think you have all the setup to do great work in the near future. And I look forward to remain a shareholder, maybe a bigger shareholder in the future. Who knows? And yes, good luck for the next years.
Thanks so much, Alex. All right, Larissa.
Thank you, Daniel. Thank you, Alex. Nice to hear from you, the words. And the next on the agenda is Q&A session. We start with the questions we have got before, but if you have any question, please type in chat or raise your hand. Daniel, the River Oak is now 8 years, and we have seen both great success and very challenging periods. How do you stay calm and focused through both good times, bad times, without becoming too optimistic, too pessimistic? Do you have any strategy?
Yeah, I think with doing something like this, shareholders have expectations. I think I can always live with those. I think I found that the largest pressure is always from myself, and it's easy to say, try to stay. Well, I just told everyone to try to stay even keel here if we do well or if we do poorly, but for any founder out there or entrepreneur who has an operating business, you know that when you're in a tougher period, trying to just have exactly the same mood as you have when things are going more smoothly is like it's a good idea, but it's like saying, try to ignore when your kid has a problem at school or, just broke up with his girlfriend um, or boyfriend and they're sad about it. So it is going to affect the mood. I don't think there's any way around that. But I think my wiring has helped a bit here. I think, yeah, I should probably thank my parents on that. But sometimes when I look back at tougher periods, it can be hard to understand why I woke up and were so happy about things. It certainly weren't too many things to be happy about on some occasions, but I think it helps to act, to not sit around and think yourself to death, but actually analyze the situation, act on it, and if you're wrong, you're wrong, but at least you've done something about it. And I think one thing that I've changed a bit since we started River Oak is I have a much more active lifestyle. So I think that really helps too, because if you're, being healthy and happy with where you are in terms of just overall shape, it really helps to wake up happy, I think. So I'd say that's a big thing for doing this over time.
Thank you. Great tips. And if you look back on all those years, how has your style of your work evolved or changed? Is there things which not changed?
Yeah, sure. I think things are remarkably the same in terms of our investment approach, in terms of my thinking on the best way to have a good result here over time. Staying focused on a few things that you understand well and not doing too many complicated things and not spreading yourself too thin out there. So it's very much the same. I do think what has changed is just experience of 8 years of running this. You understand what it means to run a business like this. 70 plus families are invested. So you learn that everyone sees things differently. They have different hopes, expectations on how we report things, on what we can do to change things. I'd say most are pretty happy as I've understood it. But still, it's been a big learning in that respect. I'd also say that, we had a first negative year. We had a first couple of years where we underperformed our benchmark. And you may remember that we didn't have that before River Oak was started. So that's certainly been a learning experience and something I've, I think, adapted somewhat to be prepared that that's going to happen. That's part of doing this, and just try to prepare ourselves as best as possible for that not to happen very often. But yeah, I think that would be it's very much, as I said, remarkably similar to 8 years ago, I'd say, overall.
Thank you. If you look on the big picture, in your last year and in your letters, you have talked about new investments in China. What is your take on the tariff battle going on between US and China? And may it have any impact on your holdings?
Yeah, it certainly had impact in April. I think the key here is with Trump, there's a few things. President Trump, it's one is very volatile. So he's prepared to say one thing and then, do a 180 a couple of weeks later. I think one example that comes to mind is I think he had a bargaining strategy with ending the Ukraine war, and he called Zelensky a dictator. And then a couple of days later, he was asked about it by a reporter, and he just said, "Yeah, but who said it? Did I say that? I can't believe I said that." And so he's changing his mind. He's not like perhaps many other politicians in terms of remaining steadfast no matter the evidence against it, so to speak. So want to protect the ego very much. He's wide open to going with the wind there, I'd say, in some respects. But I think the key here is that we people and companies, most importantly, will adapt. So whatever shakes out with tariffs, yeah, companies will adapt, have adapted over the past 100 years, whatever the crisis has been. I think we all have a COVID in fresh memory. It looked like we'd never be able to do some things, March, April of 2020. I think everyone can remember how they felt at the time. Things looked darker than ever, probably in their lifetimes. But yeah, quite quickly that turned around. Vaccines came out and might have ended up being a positive in many respects. Not saying the tariffs will be a positive, but I do think companies will adapt. And the important thing for us is stay focused on a few companies that I understand well, and they will do fine in any market environment.
All right. Then we have one more question on the US. Companies in US are generally more expensive than its European peers. Is this an opportunity or there are general reasons for the valuation gap?
Well, I take it to mean it's probably the opinion of where the question comes from, that it's more expensive in the US. I think I would agree with it. As I mentioned, we did sell a few of our US holdings in the past 6 months for valuation reasons. I do think it's somewhat bubbly, so to speak, in some pockets in the US and has been for some time. You could see that those pockets were more severely punished in April. But I think as of now, most of them have recovered anyways. So I think I go on it on a case-by-case basis. So it's not like I'd say, no, the US is too expensive now, I'm not going to do anything US this year, or Europe is too expensive, or Sweden is cheap now, so we're going to do everything in Sweden. But it's always on a case-by-case basis. I think maybe right now I just finding a few more things in Sweden rather than the US, but that's also preferable generally. And yeah, because we're more at home here, and in the US we're limited a bit by investing in larger companies because I don't know what happens with the smaller ones in many cases in the US, sort of what's happening on the ground, and get a feel for how strong the products are and so on and so forth. Much easier in the Nordics. So that's what I would say on that. Like, we've had periods over the past 12 years where the US has been more richly priced, more cheaper priced, and it affects us more on a case-by-case basis. For example, as with Meta, when we did that, it was a case where things got a lot cheaper, and so it's not something that goes very much into what I think day to day.
All right, thank you. We have got the question from the chat, from Dennis. Hi, Daniel. Always a pleasure. How do you approach learning new knowledge areas? I have been thinking a lot and learning about AI, which could potentially be one of the most disputed technology developments of of our lifetime. What over time has been the best way for you to learn generally?
Hi, Dennis. Good to see you. I think I'm big on books. Of course, nowadays with AI, if you have a bunch of books that you plan to read, let's say 5 or 10 books, that used to take a few days or weeks back in the day, but now we can do it in a couple of minutes. Give me the main takeaways of this and that book, and it actually does a pretty good job, I think I found. But I sympathize with you on AI. I think it's moving extremely fast, and I have given up a little bit on trying to follow the latest models, number of million or billion parameters and whatnot. It's just moving too quickly. So it's getting harder, let's say, than it was 10 years ago. I had the feeling that it was easier to stay more on top of things 10 years ago than it is today. And it will probably only get worse in that respect. But yeah, I've always been big on books and writing down my main takeaways. I happen to do it in Evernote, so it's always available. Like if I want to look something up if I'm somewhere else, I always have it easily available on the phone. So I'm old school in that respect. I use Evernote and Dropbox pretty much, and that's how I tend to learn most subjects actually. Read a lot on it, talk to other people about it, write down my main key takeaways on the subject, and yeah, have it readily available and go from there pretty much.
All right, thank you. One more question on AI. Do you think the use of AI can give River Oak any kind of edge in investing?
I do think it's a very valuable skill to be able to ask good questions to the different AIs out there. I think there's a big difference between the questions that people pose to the AIs, how much help and benefit you get out of them. And that certainly comes with experience. I'd say a few areas where it's helped, like when I'm researching a certain company or industry, and I want to, I had to go to 5, 6 different places, aggregate the information, put it down perhaps in a notebook or a Excel file or something, and then do the analysis. And now I can do the same thing in a couple of seconds or a couple of minutes. So it's extremely helpful in many respects, but of course that's available to anyone out there. So I don't think I haven't seen any big, because it's probably used already out there by many investment firms already. I am sure that many use AI much more in a sophisticated way than I am, and we are at River Oak. I would think that it's already been on the market for a few years, and I haven't seen any changes in terms of taking away opportunities or anything of that sort. One thing that's been happening, I think anyone who is following a few companies or the markets out there have seen that too, that during reporting periods nowadays, a company reports bad results, the share price can easily be down 20 to 30%. 10 years ago, I'd say, or maybe even 5 years ago, a really bad report would be 7% drop. And now that same report is a 30% drop in the share price. Of course, 1 quarter later, when the same company reports just somewhat more positive tones in their business, the same share price can be up 30%. So those swings have gotten wildly larger than they used to be. Whether that's, I don't think that's related to AI specifically, but it's certainly a lot more automatic trading, probably. It's probably also, margin calls, which, so yeah, that goes under the automatic category, I guess. And probably also more retail participation after, I would guess, after COVID. Retail investors would be more emotional. And if something starts go up in a day, 5, 6, 7%, people jump on it, then all of a sudden you see a 30% rise there, and the same goes on the negative side. But yeah, I wouldn't say that's AI related, actually. I don't know, to be honest. If anyone has a good idea, please let me know why it's looking like that. But so no, I would say so far on AI, it's a huge help. But I expect that many investment firms are using AI well.
All right, thank you. I would like to give a word to Thomas. Please.
Hi, Daniel, Larissa, good to see you. One question I have, can you provide us some more insight in the number of stocks you have currently in portfolio, and also in percentage, you don't have to reveal a name, what is your biggest position in percentage, your number one?
Sure. Hi, Thomas. Thanks for the question. I think the number of companies would be 8 plus our China basket. So call it 9 if you count the China basket as one, which I do. The largest one would be around 25%, and the smallest around 5%.
Okay, thank you.
All right. We have you already mentioned some of the answers to this question in your introduction, but I would like to read this still. You mentioned before that you aim to increase liquidity in the share by bringing in new investors. Is this the primary to meet selling demand, or to strengthen the company long-term position?
Yeah, a good question. I think a little bit of both. I think, as I mentioned, a few reasons for why it would be good for us to have a slightly larger capital base. We don't need a much larger capital base to do what we do well, and we can certainly do it well today. But yeah, it would be healthy for that reason mainly. But I think it's important to remember, the journey of River Oak so far. We started in 2017 with 10 shareholders. That expanded to about 70, a little more than 70 today, and 70 families over 8 years. A lot happens to you in life. It can be anything from moving cities to, you need to buy an apartment for your 18-year-old kid. When we started out, this kid might have been, 10 years old, and then 8 years later is moving out. So people will sell for all kinds of natural reasons. Starting their own business has been one reason. I can recall right now buying a vacation house in the Alps has been one, and that will happen. And I think that's true for any investment firm, or really any firm which has shareholders. So I think just expanding the network is something that would be very good to meet. Give liquidity to those sellers. That's why I try to highlight the quarterly trading window. But again, any buyer and seller can transact in between the trading windows as they want, which happens from time to time, as you have probably recently just seen. And the larger network we have, the better for everyone. It opens doors, and it was probably something I should have spent more time doing in the past. And I think it's mostly that I've realized that rather than something else, really. We have a pretty well. One thing I should mention here, we have a pretty robust shareholder base today, I'd say. When we went into 2022, many of our Swedish owners had owned their River Oak shares through a capital insurance account. And this capital insurance account has a tax rate which is dependent on interest rates. So when 2022 hit, not only when the market goes down, that's never very helpful, but also we had a couple of other things that hit us. One is this the solution that everyone used for their capital insurance account, a company called Captena. Their cost went up quite significantly. In addition, the tax, so sort of the cost of ownership through Captena, went up quite a bit as well, from something like 0.4% to more than 1% on the tax part. So it hit us in many ways, and everything came at the same time. And then of course we also had 6 years before that with no sellers. So I think it's perfectly natural that we have a few, and that will continue to be the case. But yeah, the actions we're taking is to have more balance, and just I think for shareholders to be a little bit more open to it's possible to buy and sell all the time, really. And yeah, I advocate the buying rather than the selling.
Yes. Some more questions from audience. Tobias, what are your thoughts on establishing an advisory board focused specifically on AI to evaluate companies, AI strategy and opportunities, particularly in the context of investment decisions?
Hi, Tobias. Good to see you. I think very open. It sounds like something I should probably follow up with you afterwards here, just to make sure I understand in terms of making the investment decisions exactly how you're thinking about that. If you want to unmute and elaborate, feel free.
Can you hear me? Yeah. Okay. I mean, when looking into the companies that you're investing to look at their AI strategy, they have not using the AI on your side, more like, okay, where are they positioned? What are the opportunities, and how do they react towards this big shift? It comes from me working very in an AI-driven market at the moment, realizing that it's a lot of companies that make right and wrong decisions at the moment. So that was my thought.
Yeah, I think that's a great idea. I obviously do discuss it, and I've had a few shareholders I've discussed that with at length too. Not with you so far, Tobias, but pretty happy to follow that up with you more specifically. Of course, it's something that you consider since, I mean, at least over the past 2 years, how they're positioned on that, and sort of what the puts and takes are for that company. There's certainly a few that you can see go out of business completely. I mean, a few areas. I mean, some on the consultancy side for some industries, it's hard to warrant why we should pay, big dollars to get 5 hours of legal advice or whatever it might be when you can just get it in a few seconds now, and usually on a very good level too, because it can be so personalized. So I can basically plug in River Oaks articles of association. I plug in our information memorandum, basically all the official company documents we have, and I say, consider that you're working as a legal advisor for River Oak, and please tell me what this document A, B, and C needs to look like. And before, that would be pretty expensive to get lawyers or other advisors to do that. So it's been something I always think about, I think, over the past 2 years. But for me, it always comes down to going back to the core. Like, is this a good business? Is this a good company with some competitive advantages? And usually all those flavors of the day, even though Gen AI is a particularly big one, as you say, that will all be of secondary nature, I found. But yeah, let's follow that up. I'll reach out and we can follow that up. It's a great idea.
I just to add, I totally agree. I think your way of looking at it is like, I think people are jumping the gun and reacting too fast, and AI will be the losers. I think it's the same rules that apply. I told that's why I like the way you invest. But there are some companies, I might see a bubble coming, which I think a lot of us are when it comes to AI. And I think one needs to be aware of that it will happen when the actual people are going to pay for services that they're not paying for at the moment. So it's interesting, but I really agree. I think the same rules that you always had apply also in this. And I think that's what I wanted to hear as well. That don't believe like this is a typical, everyone thinks it's a really big thing, which it is, but it's the same rules that apply for any company as always. But I would love to chat. We can talk more on a later base.
Let's follow it up. Thanks, Tobias.
Thank you. One more from chat. When you are reviewing historical financials of a new company, what are the KPIs that you immediately gravitate to? Can investment be made just purely looking at this track record? And on a somewhat related note, how do you approach very young companies that are growing fast, but with immature profits and margins? We have all learned probably profound lessons here in 2022 of the perils of investing behind companies with little near-term profits. But in the correct lesson for all of us to avoid them?
So on the first question, my way is actually quite old school there too. I think I like to do plug in the last 5 years financials. I know I can get that from maybe an AI or all these nice tools like Ticker, but I found that you can't really always trust them, and you more importantly, you're not going to learn much. But if you actually plug them in yourself, this is pretty quick. I mean, it's usually a couple of hours for a new company, but that's how I usually do it. Then I can very quickly get an overview on trajectories of revenue, margins, particularly important for me. Especially, I'd look at free cash flow margins. I'd especially look at the revenue breakdown. So I think revenue by itself doesn't really tell you much, because you can have a story where revenue is declining even, but then you have one division within that company that is growing massively and with a huge competitive advantage. And of course, you will miss all that by looking at these screening tools, or maybe an AI will probably be able to sniff that out soon if it's not already able to, but it probably is. But so, yeah, I'd say revenue breakdown is big. Free cash flow margins, how that relates to profit margins, because obviously the cash flow statement, you start with the profits, reported profits, and then the cash flow statement adjusts that profit statement and says, okay, so you had this profit line is nice, but the true earnings power for your business or for our business is whatever the cash flow statement shows. So because there you have the adjustments which the profit statement doesn't show. So I think that's much, much more important than the actual profit statement, the true earnings. But this is one piece. Like, I'd never invest only based on that. For me, it's a big piece. But the future is always going to be the bigger piece. Always, I'd say. On the young companies, personally, I try to stay away from most of them. This goes. This is not because I have anything inherently against them as a person or as I think it's great that we have them. But for me, the way River Oak is set up, we have our primary goal, which is not to lose money and try to make a 15% annual return. And if I'd find that pretty hard to do with companies that are too early in their journey. My sweet spot has generally been, at least in the Nordics, something like an 8 to 12 or 15-year life. That's usually when it's ideal for us to invest. Because at that point, you have established your company, the products and market fit is usually there. So in some respects, you take away that risk, which the private equity and startup investors have to take. And they do a great job too, because otherwise we'd have much fewer companies that actually get to the 8 to 12-year age. But yeah, that's something I found, and I don't think it's the lesson for all of us is that you should never invest in an early company. It's just, personally for me, I don't think I'm as good at that as I am at maybe investing when the company has already been here for 8 or to 15 years, thereabouts. So yeah, River Oak doesn't do much of it. And I think even if we go to the private side, it will tend to be more established companies rather than the very early stages. My advice usually, actually, when I've had private companies come and ask for investment, has usually been, I think you're a little bit too early, asking for investments. I think develop the company a bit more, hang in there a year or two more, and you'll get a much better deal with investors. So that has certainly been the case, actually, over the past couple of private deals that I've looked at. So it's somewhat of a different game, and I think if we would do it, there would be something like a 5 to 15% limit. Like, that's what we would have in our portfolio in those very new, unproven business models, which maybe I have a big, I believe strongly in their potential. But yeah, when it's not proven, I'm happy to give those potential profits to other investors that do that part better, would be for me. But yeah, everyone has their own has to find their own perfect balance there. I certainly think if the profile is such as River Oaks or similar to it, I certainly think that largely eliminates companies that lose a lot of money every year, even though those may be much better investments over 5 or 10 years.
Right. Thank you very much. Let's see if we have more questions from the audience. No, that was the last one. Thank you very much for all of you who ask and send in your questions. Thank you, Daniel, for all your answers. I wish you a great evening, and I wish you a great weekend.
All right. Thanks, everybody.
Thank you.
Bye.